What do you get if you combine the stock market and the collectibles market together? Well, you get something like Otis, Rally, or Alt. Well, what exactly are Otis, Rally, and Alt? What are those companies? What do they do? Are they a scam? Are they legit? Well, that's what we're going to talk about today. Well, it's Friday, so that means it's Financial Fridays. So today we're going to look at sites like Otis, Rally, and Alt, and there's just a ton of others, and they keep popping up. If you have any experience with a company like this or one of these types of companies, please comment below. I'm kind of curious your overall experience. I recently talked to the CEO of Otis, and he was an original founder, I believe, of Skillshare, and I kind of went over what his company was about and how it works. So let's talk about how these types of company actually work and what they do. So like the stock market, you buy a share or a stock in the company, let's say like Tesla, for example. And if the Tesla is doing well, then and more people want to buy into Tesla, the stock price goes up. If Tesla comes out with a bad product or the quarterly report isn't very good and people want to get rid of their stocks, that means the price will go down. And so your stock or share in the company is worth less than what you paid. With places like Rally, Otis, Alts, and other ones like that, you don't invest into a company, you invest into a particular collectible. So you will invest in, say, a Fantasy 15, CGC 80, or a Blastoise first edition PSA 10, or some baseball cards, or art, or shoes, or anything, video games. So you don't invest into the company, you invest into a particular item, a collectible. Now, some of you out there, and probably most of you, probably don't have 50, 75, 100 grand to drop on a comic book or a card or a piece of art or something. That's where like Otis and Rally come in. You basically buy a percentage of that comic book or card or whatever. So let's say a comic book's worth like 100 grand. Well, you don't have 100 grand, but you have 5 grand. And so you'll buy 5 grand worth of shares in that 100 grand comic. So let's just say for easy math, each share is $1,000 because they set the share amount and you put in 5 grand. Okay, now you own 5% of that 100 grand comic. So as the price of the collectible goes up, so does your share price. And also they have a secondary market where you can sell your shares or stocks in that particular comic book or card or collectible. Let's say, for example, an AF-15. Say you have a few shares of it. Well, normally a customer coming on their website and just buys shares directly from them if they still have shares. But what happens when they sell out all of their shares? Well, then you have to go to the secondary market, and then someone like you, if you have shares of it, you can put it on the secondary market and people can buy those shares, just like a stock if you wanted to sell your stock. So how do these companies make money? There's two kind of main ways that they make money. One of the ways is every time someone sells or buys on the secondary market or something like that, they have to pay a transaction fee. Another way that they make money is off the original purchase price of that item. So let's say they buy a $100,000 comic book and they list it on their website for selling shares of it. They will list it at a higher amount than what they paid. So let's say they had a $100,000 comic. I don't know exactly their percentages, but they'll list it for like 105,000. So every time you're buying a share, you're buying it at an inflated price. So all this seems pretty good and legit, right? Well, here comes like my main issues with these types of companies. So for a stock like Tesla or something like that, you have one. There's only one Tesla. There's no multiple Teslas on the market or anything like that. There's just one. There's similar companies like Tesla, like other EV company stuff. But with comics and collectibles, there's hundreds, if not thousands. For example, Amazing Fantasy 15. There's tons out there. So you can, when one sells, you can get basically a guess on what the market value is for your current one. There's only really one Tesla. And so you have to base it off of what products they're coming out with, how well they did on their quarterly reports, and all that kind of stuff. But with comics, let's just say, the moment someone sells a Fantasy 15, an Action 1, whatever it is, even like a Spider-Man 300, That then sets the bar of where the market value is for that particular collectible. But with places like Otis, they are setting the price and telling you to buy a share at the price that they set, not what the market sets, but what they say it is. Now, that's fine to a degree. I kind of do that as a comic book dealer myself. Like, let's say in auction, a book sells for 20 grand and I have the same book and same grade or whatever. And I'm like, well, I think it's worth more than 20 grand. So I put it up on, my site or something like that, and I want 25. And it'll sit there. Maybe I sell it within a week. Maybe I sell it within a month. Maybe I don't sell it at all. But maybe I have to drop the price. Who knows? But I'm putting a price and I'm saying, hey, market out there, who wants to pay this price? And maybe someone does come along, yeah, I'm willing to pay that price. But with places like Otis and Rally, they're setting the price and telling you what it's worth without actually ever selling the product themselves. So what's to stop them from just always raising the price? They could just say, well, now it's worth 100 grand. Now it's worth 120. Now it's worth 150 without ever actually selling the product and seeing what the market will actually pay for it. So I've narrowed it down to like 4 main issues that I have with these types of companies. Number 1 is they set the price, not the market setting the price. Number 2, they list their collectibles and sell their shares at an already inflated price above what they paid for it. 3, who's to say they even have the collectible that they're selling shares of? And then 4, bankruptcy. And I'll go into details of each of those a little more extensively. Okay, so here's an example of what I mean by they are setting the value when it should be the market sets the value. So here we have Vandas 452. They have a 9.6. Scroll down here. They have it listed for $24,000. Each share is $24. But if you come over here and you look at the recent sales, right, for a 9.6, Heritage sold one for $21,000, so more. They have one from Comic Link, 9.6, sold for about a year ago for $19,000. Comic Connect sold one for $24,000 almost 2 years ago. So is this a case that they're going down in value? I feel like with Black Panther, he's really popular when his movie came out and the Avengers and stuff came out, but I think he's kind of settled down a little bit. I still think over time it will go up, but if you're looking at the short term, right, I would not value this at $24,000 like they did. Like the true market value of this is probably somewhere around $21,000, $22,000, right? But they're saying it's 24. And the thing is, they're not putting on their website saying, hey, we want to sell this for 24. They're putting it on their website and it's like, it's worth 24 and you have to buy a share at the $24,000 price, which is 24 bucks a share is what it looks like they're putting it out. So here's the other issue I have with it is when you buy it from them or buy their shares, you're buying it at an inflated price that they set. So if you look at this X-Men number 192, they're setting the drop price, which is what they say it's worth, at $136,500. Each share is 75. I don't know their math, how they come up with it, but if you look at the picture, you can see that the serial number is 99001. Well, I can see how much they paid for it. Here we go, 92, 134,000, 9901. That's this serial number. So they bought it from Comic Connect for 134,000. They instantly listed on their website. Well, I don't know how long it's been up here. It might not be instantly at 136. So they are telling you that you have to buy it at a premium. You have to buy it $2,500 more than what they bought it for. When the market is, if you look at it, it's the market. So maybe they're including inflation or whatever, but who's to stop them from another one selling? What if they put it at 150? Well, yeah, it's worth 150. And that's what I'm saying is they could just say whatever price they want and you're forced to buy. Now, obviously, X-Men 1 is a great book and it's going up in price. But what happens if it goes down? What if they buy a bad book? Are they just going to constantly say that it's going up? So, and here's evidence of them doing that. Look, they have a Blastoise, PSA 10. They're calling it roughly $48,000. That's what they're saying it's worth. If you check, like, there's not that many to sell, but if you check on eBay, here's one that sold in December for 31,000. 31,000. Not even close to this price. So they kind of make up the price, but you're forced to buy the shares. And that's like my whole point. If this was theirs and they say it's worth 40 cents, they could say it's worth $1 million. It doesn't matter. If they put it up there, you have to get someone to buy it. But no, what they're doing with their customers is they're saying, no, it's worth 48,000. And then they give all these like market analysis and say, and, oh, this is what it's worth and all this kind of stuff. But it's like, you're forced to buy it at the share price. And then also on the secondary market, you're forced to sell it at the share price. But what if no one wants to buy it? What if no one wants to pay? What if I come along and go, that's not worth 48,000. I'm not buying a share at that because I did a few seconds of research to find like, okay, maybe it's worth around this. Or you're telling me I have to buy a share price at this price when I don't think it's worth it? Okay, now I don't know exactly how it works, but are you stuck with that share until someone pays the 48,000 price? Are you stuck until someone's willing to buy 1% of it at the 48,000 price? Are you stuck with that share? And if you're allowed to lower it, and you're like, okay, I'm gonna lower it to 1% of 32,000 because that's what I feel it's worth. Well, then wouldn't that change this price? Which I don't think they would move that price if someone's like, oh, I'm only gonna pay $5 for that share, not 10. I don't think it's worth that. And someone pays $5 for that share. Does this then get cut in half? This 48,000 now it's worth 24,000. See where I'm going with this? But they set the price, so they can set it whatever they want. This brings up my third point. Is how do you know that they actually own this? Like they have a picture of it. That's great. And you're assuming that they have it. You can go to their New York office and look at it. But are you actually going to go down there, take a plane flight, and fly down there to be like, oh, look. So they could easily just say they have these things and collect money from you as if they did. And you people are buying and selling the shares of a fictional thing that they don't actually own. Because at no point do you have to say, I bought 100%, let me come down and get it from you. No, they keep a percentage of it themselves. So I think and if you sell it to them, like if they buy it from you, like that's what we're talking about, we can keep a percentage of it as well. But at no point, they could, without anyone knowing, they could take this Blastoise and they could sell it to some collector, pocket whatever they sell it for, $30,000, $40,000, and then keep it on their website. And people keep on buying and selling and trading and all that kind of stuff. It doesn't actually exist. Because if you actually own the product, I can go into my closet and I can pull out, here I have the actual physical, whatever it is, Turtles #1, Fantasy 15, whatever it is. But with this, you're assuming that they have it. And what if they're great and they do have all this stuff, but what happens if all of a sudden their company starts bleeding money and they need money? They can't get another round of funding. They have a bad person that works there and just wants to basically steal and sells a bunch of the stuff and goes, oh, don't worry, I'm going to pay it back or I'm going to get it back one day, and never does. And then, once again, they have all good intentions, but something happens where, their back's against the wall and now they need money, so they sell a bunch of assets without letting people know. There's no way of you ever knowing. One of my main issues with these types of companies is the potential bankruptcy thing. If you own the collectible, the comic, or whatever it is, you could sell it at any point. It's yours. You own it. With these companies, if they file bankruptcy tomorrow, you lose everything because you don't actually own the comic book. You own a percentage, but they actually physically have it. And so they have to sell it, get rid of it, and pay down their debts or whatever. So you buying a share, you're assuming the risk that they will be a company forever. If you it's different from buying a stock in, say, like Tesla, for example. If you buy stock in Tesla, let's say they screw up massively, all this kind of stuff. You can see the price dropping over time, right? It's not going to go from all of a sudden 700 a share down to zero within a second. Like, you'll see it dropping. It'll have like, a 10% drop day, a 20%, a 30% drop day. So at any time you go, oh no, like all of a sudden Elon Musk died and the company's folding and they're embezzled and all this kind of stuff, all that stuff happens. So you could sell and at least get some of your money back. Like maybe you got it at 700 a share and it goes all the way down to 300 or 200 a share. You still got some of your money back. With places like this, you have no control because you don't actually own the comic. If something happens to that company overnight, it's gone, right? Boom. Even if a company that you have a stock in files for bankruptcy, it's not instantly down to zero the next day. It drops drastically and continues to drop. But during that time, you still can get rid of stuff and still have some value in your stock. Even if it goes from 700 to $1, at least you got $1 back, right? But with these companies, it's like if it goes, you have no control over the company. It's just gone instantly, your investment. So all these companies are VC, venture capitalist funded companies. And that's why the possibility of them going bankrupt or out of business is actually very high. So the way VC companies work that are funded is they prioritize getting users more than they prioritize getting their product to be successful or their service to be successful or whatever the reason the company exists. So the way it works is you have an idea, you get some funding, and then the funding is just meant to grow the company. What does grow the company means? It means to just get as many users as you possibly can, even if your product is garbage. It makes no difference. There's a good video all about it. I'll link below in the description that talks all about it. It's not meant to take that money and to make your product better or your service better or your website better, whatever it is. It's meant to just grow. And so what they do is they take all that money and they just buy ads on Facebook, Google, Amazon, wherever they buy ads, and then they just try to get as many users as possible. Then what they do with their, say, $5 million investment, they then grow it from, say, 10 customers to 10,000 customers. Then they take that and they go to the next venture capitalist firm and they're like, look, with $5 million, we just grew to 10,000 people. All right, now we need $50 million. And they need a substantial more. They can't be valued at the same level they were before. They have to be valued at way, way higher because that just looks better. So they're like, okay, if you give us $50 million, we can grow this. And they're like, awesome. And then they'll grow to like 1 million users. And then they'll just keep on doing that, getting funding more and higher than the last round of funding that they got from different people. And every time they do that, the previous people get paid out. And that's how they make their money. And they keep a little investments in the company as well. Or they keep it all and they just let it ride. So then they get to this point where they're so huge because how much they've been valued. You'll see it on like news and stuff like that. Oh, so-and-so company got valued at $1 billion, whatever. They get to the point where they're so huge, they have one or two options. They either, because they can't get funding anymore, you can't just keep on, at some point you gotta basically cash out. So this is how you cash out. You either get so huge that you sell to one of the huge companies like a Google, an Apple, a Facebook, something like that, or you sell it to the average person like you or and I. And that's what they do. They IPO, go on the stock exchange, they hype the crap out of it, and then all of a sudden, people like you and I go, oh, this company's so good. They grew all these users. They have this huge base and all this kind of stuff. And then something like Uber and all that other stuff. And then so you and I will buy up the shares. And that's how all the people down below that invested, all the VCs and all the founders and stuff, they cash out. And that's how they make all their money. And they cash out. I mean, they'll probably keep some of the money in the stocks or whatever like that, but they cash out or they sell it to a big company, and people like you and I basically fund that company. That's why all these big companies are always losing money, with us holding on to the hope that one day they'll figure out how to make money. Like I was watching a thing just earlier, it's like DoorDash lost $150 million, but you hold on hope that one day they'll get it together because they have so many users and they're so big that eventually they'll figure out. Who's to say they ever will? And that's why they never want to turn a profit, because once you turn a profit, then you can calculate how much they're worth. So their whole thing is to grow, use as much money as they can to grow without turning a profit. So that's my kind of issue with these types of companies, is they're not coming from a person that, oh, I love collectibles, I'm trying to make a better way. They look at it like, I'm from Silicon Valley, how can I reimagine the way that the collectible market is working? And it's booming right now, so I want to make some money. So they come up with this idea. The guy is a founder of Skillshare. What does that have to do with collectibles? Absolutely nothing. and he's not even a collectible person. He just sees an opportunity where he can make money. And the thing is with VCs, they invest in hundreds of companies a year. And they know most of them, like 9 out of 10 of them fail. And they know that. But one of them will turn into the next Uber, the next Facebook. I mean, that's when they make billions to fund all the crappy ones that failed. And so a lot of times you'll get funding, a first round, second round, and then that's it. Then you won't get any more funding. You know what happens then? Gone. The company's nothing. My brother, he is in that space. He got a couple rounds of funding, sold his company to GoDaddy. Now he's on his second company that he's creating. And they just got, he got his first round of funding, and and he says the moment he gets funding, he's like a politician. All he does is try to go and find more funding. He doesn't work on his product. Like, he does hire people to work on it, but he says every day, I'm not working on my product. I'm literally just going to find funding. And as soon as he gets funding, what does he do? Goes and tries to find more funding. And that's all you do, is constantly raise funding. And so he sold his first company. He's on his second company, and he got about 9 months worth. He projected his first round of funding. He has about a month or two left, and then it's gone. And I'm like, well, what happens when it's gone? He's like, well, then the company's done. And I'm like, it is? He's like, yeah, there's nothing I can do with it because it's not fully fleshed out, because the whole time you're trying to raise. And when you're raising, you're not actually investing in the product as much as you are trying to grow. So you're hiring more people. So it looks like you have this huge staff. You're buying tons of ads. So it looks like you have this huge customer base, not actually focusing on making the product the best it is. And maybe the product is garbage to begin with, but your whole idea is to peddle it off to someone else who thinks it's something. And so if he doesn't get a round of funding, the company's dead. So what happens then? It's over. The company's done instantly, just like that, because he has no more funding. And that's very common in the Silicon Valley VC world. And so that's why I'm afraid with all these types of companies is the moment that the funding stops, because the next level up doesn't see the value that you see in it, it's done. And so what happens to all those people that own, a percentage or shares of these collectibles? It's gone, instantly gone, because you don't actually own it. You can go see it if you want to go to New York, like with Otis, but who's going to go there unless you live right next to it? You're going to fly out there just see, oh, look at that. In their warehouse, they have that book that I own 2% of, right? So that's like the scary part of this, is it could literally overnight, depending on the company, it could just be gone. And there's nothing you could really do about it. And I have a feeling there's tons popping up. And that's the issue with venture capitalists. They have FOMO. One person invests, so it's like this Skillshare guy. He got a bunch of money. Then all of a sudden, the CEO or something like Reddit, or one of the founders of Reddit, is like, oh, I need to be in that space. So he instantly got all this funding to create another version. That's called alt. And it's like all these people are like, and then all of a sudden there'll be another version. And all these people, these VCs are like, we need the next biggest thing. This is going to be it. And so they just throw money at everything. And eventually what's going to come across is there's going to be some companies that aren't ran very well, and a bunch of people will invest in like, oh, I have all these stocks and these baseball cards, these comics, and the company will go under, and then they'll get burned. And then the whole thing will collapse, because it's not based off building a quality company. It's based off, let's see how much we can grow this company. Not like, let's understand it and create like a community. So that's kind of like my issue with the whole bankruptcy and the VC things. It's just so risky, and they're not coming at it with a collector's mentality. They're coming at with it as in more of like a Silicon Valley vibe. So in summary, I don't think these companies are a scam. I think they're legit in the fact that they are a real company. I just think that they're a mixture of Silicon Valley and venture capitalists trying to get into the collectible space and make money off it, which is fine. There's nothing wrong with trying to make money. But as a collector of these cards, art, shoes, whatever it is, the reason why people collect is they like to show it off. It makes them happy to obtain these things, to have a run and you finally complete the run, or you've always wanted this certain shoe or book and you finally got it and you hang it on your wall or whatever it is. That's the whole point of the collector. So they're willing to pay to have that thing. Having just a share of something is not that special. What do you tell your friends? Oh, I own 1% of that Fantasy 15 that's on that website. And they're like, okay, it's not as cool. It's not as glamorous. These companies are devoid of all that happiness and joy. And that's why I just don't think it'll work in the long run. So I think it's kind of like a neat idea, but I just don't see it working out in the long term. The risks aren't worth the rewards per se. I mean, I could be wrong. It could become like the next eBay, next Facebook, next big thing that people do and use. But I just personally don't see it. So, but those are my thoughts. If you have any experience or just your overall thoughts about something like this, trust me, if you haven't heard about them, you're going to hear about them because there is Silicon Valley is like all over this. So they're gonna be popping up left and right, left and right. And so just tell me your thoughts on it. If you have any experience with it, I'm just curious. So yeah, thank you. Please subscribe, like, share. All right, thanks.